Hi. Again, this is Ria C. Sibi. And this is Chapter 19 Deposit Insurance and Other Liability Guarantees. Because of wealth, money supply, and credit supply effects, government regulators of financial service firms have introduced guarantee programs to deter runs by offering liability holders varying degrees of failure protection. The causes of the depository fund insolvencies. The financial environment. One view of the cause of insolvency is that a number of external events adversely impacted U.S. banks and thrifts in 1980s. First, the dramatic rise in interest rates in the 1979-82 period. Second, the collapse in oil, real estate, and other commodity prices. Third, increased financial service firm competition at home and abroad. Moral hazard is the loss exposure faced by an insurer when the provision of insurance encourages the insured to take more risks. There are three ways deposit insurance could be structured to reduce moral hazard behavior. First is increased stockholder discipline to prevent excessive risk-taking through a risk-based deposit insurance program and through increased capital requirements and increased disclosure. Depositor discipline. Depositors could either require higher interest rates and risk premiums on deposits or ration the amount of deposits they are willing to hold in riskier DIs. Critics argue that under the current deposit insurance regulations, neither insured depositors nor uninsured depositors have sufficient incentives to discipline riskier DIs. Regulatory discipline. In the event that stockholder and deposit holder discipline does not reduce moral hazard-induced risk-taking by banks and thrifts, regulations can require regulators to act promptly and in a more consistent and predictable fashion to restrain DI risk-taking behavior. Deposit insurance and other liability guarantees. Non-U.S. deposit insurance systems. Deposit insurance systems are increasingly being adopted worldwide. Many of these systems offer quite different degrees of protection to depositors compared with systems in the United States. The discount window. Traditionally, central banks such as the Federal Reserve have provided a discount window facility to meet the short-term, non-permanent liquidity needs of DIs. For example, suppose a DI has an unexpected deposit drain close to the end of a reserve requirement period and cannot meet its reserve target. It can seek to borrow from the central bank's discount window facility. That is all. Thank you.
Created using Powtoon.